interesting. And we talked about the move in 2014 or 13, 14, after QE3 from high quality names. I began to sell those. And again, I think that's when the valuation disconnect really picked up pace, was in 2013, especially for small caps, where the dispersion between price and value grew considerably. And as I rotated into asset-heavy companies, many of the commodity names, I began to underperform, especially at 13. 14, 15, relatively I did okay, but not on an absolute return basis. I was pretty much flat for those 2 years. But what I liked about the portfolio in 14, 15 is I had significant discounts. They just were in uncomfortable securities. Again, the commodity names were very difficult to own. I don't know if you've ever owned a miner that's been down 90%. It's extremely uncomfortable. But they were 50-cent dollars again. And so I added to those positions as they declined. I maintained weights. And then in early 2016, or the spring of 2016, it actually worked out. And many of these miners doubled and tripled and reached my valuations. So I began to sell. So all of a sudden, I had a portfolio with a large amount of cash. I had about 80% cash and about 10 to 15% weight in miners. And that was okay, because if they're 50-cent dollars and they doubled, I could make 10 to 15%. And that's where we were year to date in 2016. So we were up around 10% in early 2016. We were doing very well relatively in absolute return basis. So as I began to sell the miners as they reached my valuation, that's when it hit me that, I don't have any more discounts. That was the last area of the market was providing real, genuine discounts. So cash started to rise to about 90%. The miners that had worked, the commodity names that have worked, I sold or was selling, in the process of selling. And the remainder of the portfolio, the 10% or so that was invested in equities, were not at considerable discounts. They were not providing me with adequate future absolute returns, in my opinion. So I was really, in a difficult position. And then I was happy that performance had improved and that contrarian position in the commodity stocks worked out. But then I began to realize I had to make a decision what to do next. And I was not going to buy overvalued stocks. I knew that was not going to occur. So the only thing I kept coming back to was returning the capital. As an absolute return investor, our goal is to generate an attractive absolute return. And if I was unable to achieve that, I thought the best course of action was to return capital. So that's what I recommended, and the firm went along with that. And we sent back over $400 million, and I went from making a lot of money to being unemployed. So it was a difficult decision. More difficult than monetary was just giving up that 18-year track record. My dream job and sending the money back, really ending the track record, I think was the most difficult decision I've ever had to take or have made in my career. So it was tough, but I think in hindsight it was definitely the right thing to do.